Welcome to the daily insights that matter. Now, a lot of inexperienced retail investors who were lured by the promise of getting rich quickly by trading in equity derivatives, or let's say the ones who had started trading with the hope of 21 din mein paisa double, have faced substantial losses recently. Now, it's come to a point where SEBI has had to ask stockbrokers to alert investors about the risks of trading in futures and options on their websites, as well as show alerts every time that they place a derivative order on the trading platform. So come 1st July, don't be surprised to see alerts such as 9 out of 10 individual traders in equities F&O incurred net losses. On average, they had net trading loss close to 50,000 rupees. They had also spent 28% more of the net trading losses as transaction costs, and in the rare instances when they made net trading profits, they incurred 15 to 50% of such profits as transaction costs. Now, similar to the warnings on cigarette packets, these alerts will cover almost half of the screen while you try to place an F&O order via your trading platform. Now, the risk disclosure was prompted by a study conducted by SEBI revealing important information about retail traders in the equity F&O segment. Now, the study found that in the fiscal year ending March 2022, the number of individual traders using the top 10 brokers increased by over 500% compared to 2019, reaching 4.52 million. Now, surprisingly, 89% of these traders incurred losses with an average loss of 1.1 lakh rupees, while only 11% managed to make a profit averaging to 1.5 lakh rupees. Now, the top 1% and 5% of the profitable traders accounted for 51% and 75% of the total net profit respectively. Now, the retail market share measured as a percentage of notional turnover increased from 23% in FY16 to 29.2% in FY21. However, in FY23, it dropped slightly to 27.7%, which was a 30 basis points decrease from FY2022. Now, this is noteworthy because retail investors are the second largest group after proprietary traders in the derivatives segment. SEBI's decision to warn retail investors about the risks of derivatives trading is significant considering their growing presence in the market. Now, in a bold move to stimulate cross-border investments and foster global entrepreneurial collaboration, the Finance Ministry has notified that 21 countries which engage in investments in Indian startups will not attract angel tax. Now, let's first understand what angel tax is. It was introduced in 2012. Angel tax is essentially the tax that unlisted companies similar to startups are liable to pay on the capital that they raise through issue of shares. So if an Indian unlisted company issues shares at a price exceeding its fair market value, it will be liable to be taxed at a rate of 30%. Now, as the funds are raised at a price above the fair market value, the excess of the funds raised is treated as income on which the tax is levied. Now, the list of 21 countries that will not attract the angel tax are Australia, Austria, Belgium, Canada, the Czech Republic, Denmark, Finland, France, Germany, Iceland, Israel, Italy, Japan, Korea, New Zealand, Norway, Russia, Spain, Sweden, United Kingdom, and the United States. Now, the classes of investors who would not come under the angel tax provision include those registered under SEBI as Category 1 FPI, endowment funds, pension funds, and broad-based pool investment vehicles, which are residents of the 21 specified nations. Now, the rigid list of countries aims to attract more foreign direct investment into India from countries that have a robust regulatory framework. Now, this is a significant development and a welcome step to ease foreign investment as it brings a host of benefits. Surprisingly, though, countries such as Singapore, UAE, Netherlands, and Mauritius, where the majority of the inbound FDI comes to the extent of almost 50% into India, have been excluded from this list. Now, this drastic step also aligns with the government's intention to bring FDI under the purview of angel tax to prevent the circulation of unaccounted money. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com